nerds. Laurie probably doesn't know this, but I communicated with email back in about, 2000, 2003 with him, and we talked about gold a little bit. And when I was switching out of banks and wanted to go to gold, my wife and I looked around the gold sector and go, well, we don't know which gold companies to buy. We know we want to buy gold companies, but we've got no idea which ones. And I know from talking to stockbrokers that they'd tell you about their favourite 10 gold companies, which invariably they had some sort of financial relationship with. But I know that there are hundreds of gold companies out there on the ASX. So my wife, who's better known as Joanne Nova to climate skeptics, decided that she was just going to list them all and work out how many gold resources they had. So she started a spreadsheet. And being a rocket scientist, I thought I could do better, and so I improved the spreadsheet a bit and so on. And we ended up realising that going through 300 companies and finding out enough details about them to be able to even sift through them in a vaguely intelligent way was much too big a job. So we started up a company called Gold Nerds, and the idea was that we would get several researchers. We got a dozen researchers, all of whom were gold investors in their own right, and basically the idea was we were going to pool the information, because Joanne and I wanted this information, and we thought, we can't get it ourselves, but if we have a small team of people, we can get it. By the way, we searched on the net high and low. There's no similar product. There's nothing that compares gold companies across the board. Even comparing a few of them is not very common. So we got some people on the net. We got friends of friends, people who knew about gold and were investors, and we formed Gold Nerds. And we decided what sort of fields we'd have, what sort of information we'd collect in just a fairly rudimentary form back in 2007. And we decided we might as well sell it to the public as well. That'd give us a bit of focus and maybe open up a bit of community feedback and things like that. So since middle of 2007, we've been selling a spreadsheet called Gold Nerds. It comes out every 2 weeks. We publish every 2 weeks. We update the information. Basically, we get the information out of the ASX reports that companies produce, that is the ASX announcements. The ASX announcements have the virtue that if the companies lie in them, there's usually fairly nasty legal and commercial ramifications, so that the information there is fairly good. Not that Australian companies have been, in the minerals field, have been anything other than pretty good by and large in reporting for the last few years in any case. But once you get in an ASX announcement, it's nearly always correct. So what we did with our Gold Nerds is set up a big list of gold companies. And I've just downloaded the latest one from the net. And to show you what's here on this unfamiliar equipment, okay. Okay, there's sort them by alphabetical list. Now, can people read that? Good. All right, start off with 3D Resources. We go on down, there's about 300 of them, I think, at last count. All right, 320 of them. And to be included on this list, you pretty much have to be of interest to someone who's principally interested in gold. So specifically, we left out large polymetallic companies like BHP. BHP own the biggest gold deposit in Australia. It's at Olympic Dam. It's also the biggest silver deposit. But there's no way you'd buy BHP to do a gold and silver investment because it's diluted amongst so many other things. So BHP aren't on there. Company pretty much has to have a pretty solid interest in gold or exploration in gold to be on that list. There are several companies coming on there every month. For instance, there's an MD here from Southern Crown. Where are you? At the back there, he's putting an IPO on. Southern Crown will be on here in a few weeks' time. What we did when Joanne and I started this is we wanted to find, like Laurie says, cheap gold in the ground. There are two basic schools in gold investing that we've discovered. There's people who buy production ounces, and there's people who buy gold in the ground. People who buy production ounces are looking for some sort of industrial type company that has a discounted cash flow, and you can analyse the thing on a return or a yield and so on. People who buy gold in the ground are generally people who think the price of gold is going to go up a lot and they want a lot of leverage to that price rise. Now, the great thing about buying gold in the ground, I don't know if Laurie explained that because I missed a small part of his talk, is that you can buy it very cheaply. If I go to the Perth Mint, I live in Perth, and we're blessed with a Perth Mint. It's really easy to buy gold in Perth. Just go to a Perth Mint, they give you a very good price. And if you come in with less than $10,000 cash, they just give you gold with no paperwork. If you go over $10,000, then there's all sorts of reporting requirements and so on. It's more difficult in other states. But anyway, if you buy gold from, say, the Perth Mint, you're paying $1,400 an ounce. But if you buy gold in the ground with some companies, you can be paying as little as $2 an ounce. All right, if you want a gold that's likely to be produced in the next 2 or 3 years and or belongs to a company that either is or is about to be producing, it costs a fair bit more, usually $100 or $200 an ounce. Furthermore, when in the course of digging it up, they'll spend several hundred more dollars per ounce. A typical mining cost at the moment is $600 per ounce. It varies. Some companies it's as low as $300 or $400. Others it's up around $1,000, even $1,200 per ounce. So the mileage varies a lot. And so we discovered that when we analysed this, we came to the opinion that the market was not very efficient, as they say. Efficient is a technical term in portfolio theory and stock markets and so on, meaning that all the information that's available on a stock is priced into the stock. We don't think that's the case at all. In fact, we're dead certain that we've come across several stocks that are just wildly inefficiently priced, either overpriced or underpriced. I'll give you an example, just to start you off. One of the things we can do is, well, see these little buttons called S? That stands for sorting. Oh, look, I should tell you something else too. Marcus introduced this as a sophisticated spreadsheet. And I'm a rocket scientist, and I have to disagree with Marcus. This was a very rudimentary spreadsheet that just gives you a rough idea of the market. Some of the other gold nerds and I have been producing a much better version for the last year or two. It's almost ready. We're about 2 months off producing it. And it goes into way more detail, and it's the sort of thing that fund managers like Laurie and those asset managers he likes, sorry, he met, but there's the sort of product they would like. In the meantime, this is a pretty rough and ready filter, but nonetheless it's pretty useful and it's made us a lot of money. One of the things it does is sort by enterprise, one of the things it does is lists about 20 categories and we can sort by them. Those little buttons that say S. And one of the fields of interest, by the way, when you print these other buttons, it says help and explains what that is. So if you've ever bought the product, there's a fair bit of an encyclopedia of knowledge in there. Enterprise value is the market value of the physical resources of the company. Enterprise value is what you get when you start with a market capitalisation. You strip out all the financial goodies, like if they've got any loans, if they've got any assets, cash, all that sort of rubbish. You say, what's left? That's the price the market's putting on their gold in the ground in their mining operations. Just an aside here. I told you I hadn't prepared this talk. One of the really good things about mining companies, and what drew us to them as an investment, was that they're relatively honest. A balance sheet for a mining company always fits in one page, and it has a few financial notes, but they're usually not too onerous, and you can pretty much work out what it's got. Right? Those big industrial companies, especially banks and so on, you haven't got a clue what's in there. You need to be an expert, you need to get all sorts of access to stuff that you can't get access to, and you just can't find it out. And then there's all those headaches like, oh, they've got $5 billion worth of goodwill. Oh, okay. What's that worth? Mining companies are pretty simple. They've got minerals in the ground, they've got cash in the bank. There was something else. Gee. They've got mines and a workforce. That's pretty much, and exploration leases. There's really not very much to them. They just have a few things. So they're pretty easy to analyse. Now, the enterprise value is of interest because sometimes, like when gold companies got very cheap, as Laurie said a couple of years ago, like the advantage, I think, the example you gave was gold core down to $11. The value, the enterprise value of them can go negative or very small, which basically means the market is paying you to take all their physical resources. All right? If you see a company with a small EV, it means the market is putting almost no value on their physical resources. So they might have gold in the Perth Mint, they might have gold in the ground, they might have a whole bunch of mines, and the company's putting, the market is putting almost no value on them. So one of the first ways of spotting bargains, as an example of how this has made us a fair bit of money, I'd like you to look at the EV column, which is the one in that sort of goldy yellow column next to the market cap. And I just sorted by EV, and I think this company is still relatively interesting. Oh boy, if I could just find it now. All right, I'm not finding it that way, so I'm just going to jump concepts a little bit. I'm not going to tell you what I'm doing. I'm just going to find it. All right, the company I'm looking for is Tribune Resources, and I'll just highlight the row. All right, Tribune Resources has at the day this spreadsheet was prepared, had a share price of $1.75. And what was interesting was that 2 weeks before it had a share price of about $1.30. And the EV, which is currently $32 million at this one, was about $10 million. And I thought, $10 million, what does $10 million buy you? Well, it turns out that $10 million buys you, from this cell over here, 500,000 ounces in the ground. And it buys you a production capability of about 50,000 ounces a year at a relatively low cash cost. I thought, gee, that seems a bit cheap. So we dug into it a bit further. And if you could read that small print, basically what it's saying is that in their other financial assets, we discovered that this company had $34 million worth of gold at the Perth Mint and basically hadn't told anyone. We reckon that was worth about $1 a share. So we thought, so we're basically paying about 30 cents for all our other stuff. Seemed like a good idea. Well, fortunately, several people at Gold Nerds and whoever customers who noticed this, we bought in around $1.30, and some of us had bought in as low as 80 cents. It went to $1.90 yesterday. I believe it's dropped back to $1.88 today or something like that. But you do get these examples of just massive market inefficiencies. Now, several people have asked, and so our subscribers sometimes ask, well, how do you use it? What do you do to find interesting gold stocks? Is Marcus here? No, he's not going to. Marcus, how long have I got to? All right, it's 3:30 roughly, okay. All right. Okay, one concept here I've introduced you to is the EV concept. So you look for companies with low EV and you think, and particularly at the depths of the GFC, there were lots of producing companies that had very small EVs and some of them have gone negative. And at any stage you can find companies with negative EV. For instance, let's look at the moment. Okay, there's only 3 companies there with a negative EV, but one of them, Carpentaria Exploration, oh, that's a special case. All right, sometimes there are a lot of special cases, but there are funny reasons for it. Don't even worry about that, I'm not going to bother explaining it. Let's go through a few of the columns and I'll explain roughly what's going on, and I'll get to my favourite columns and show you what we do. The number of shares. Number of shares tells you something interesting about a company. It tells you in a single number how good the management is. Because when companies start out, they nearly always start off with about somewhere between 20 and 100 million shares, usually issued at about 20 or 30 cents. And if they don't find anything, or if they need more money from the market, they keep going back to the market and issuing more shares. So companies that aren't very successful or are having difficulty getting started, keep issuing more shares. And after a while it's 500 million shares, then 1 billion shares, then 2 billion shares, then they reconsolidate. 10 to 1, 20 to 1, 30 to 1 or something like that. On the other hand, there are companies that pretty much get everything right. Their management's good, their property's good, and the number of shares in those companies is really small. Tribune, for instance, I think has about 50 million shares. Newcrest Mining, our biggest company that's been around since the early 90s. Easily the biggest gold company, the most successful company in a gold mining company in Australia. Not one I'd own, but because it's not very exciting, not because it's not a good company, it's a very good company. They're bad companies, just that they're not very exciting. See, as companies become bigger, especially when they're producers, and their market cap goes up, people like Laurie go over them with a fine-tooth comb, and they tend to bid them up to their real worth. That is to say, they become more efficient. Right? The market becomes more efficient as the companies become more recognised, because analysts go over them. But once you get below about, well, it's probably around 400 million, but certainly below 200 million in market cap, you're in a wild west country. No one knows anything about these companies. Hardly. And so, opinions vary, and you can buy some real bargains, and there can be some really overpriced stuff. So if you buy below $200 million and 300 million shares, you're generally into some interesting territory. We consider their options, we consider their cash. Oh, cash. Cash is king some of the time. Here's just a quick note. the market goes through phases. Remember I told you there are two sorts of investors, those who buy production ounces and those who buy resource ounces. The market is schizophrenic. Sometimes it's mainly one, sometimes it's mainly the other. For instance, in 2007, before the GFC, the market was tending to buy production ounces in the ground. You could see it. The companies were, sorry, ounces in the ground, not production ounces. They were buying ounces in the ground, presumably under expectation that the gold price would increase a lot. GFC comes along, and suddenly companies can't raise any money on the stock market, and their share price is shredded. And suddenly cash flow is all important. Are these companies even going to survive? And so the amount of cash they had and the ability to produce became all important. So producers were worth something and all the rest of the companies were hardly worth anything at all. That's now unwinding, and I think you'll find in the next year that although the last 2 years have favoured producers, we're going back more towards a situation that the gold in the ground will probably become a more important part of the overall valuation. So cash, yes, keep a track of cash. You find that, well, the rule of thumb is any company that's got less than $1 million in cash is usually in trouble unless it's a very small exploring company. If it's any sort of producer and it's got less than $10 million in cash, probably in trouble. A lot of companies have investments, that's cool, we just add them to the bottom line. Hedge book. There are still companies out there with large hedge books. And the big one on the ASX is Anglo Gold. Anglo and Barrick had monster hedge books that they're still trying to unwind. Massive financial damage that have reduced the value of those companies enormously, particularly as the gold price is now well over $1,000. So be very careful of buying companies with hedge books because you just don't capture nearly as much of the gain in the price of gold, and perversely the company can go broke if the price of gold rises too high. Fortunately, there isn't much hedging left on the Australian market, and what there is tend to be put options rather than the old traditional type of hedging. A put option, you merely lose, the company just merely loses the money that it paid for the put option. It doesn't endanger the company, and it won't send it bust the way, what's that big, Sons of Gwalia went bust a few years ago. No, never mind. All right, so I've covered market, you all presumably know what market cap is. Enterprise value is the more interesting thing where you take away all those financial bits out of the market cap. We look for bargains in the EV. Where a company is headquartered is sometimes important for obvious sort of financial, reasons to do with what happens when fiat currencies start failing and gold becomes more interesting and maybe countries start nationalising their gold. If Australia ever decided to back its currency with gold, I imagine the first thing they'd do would be to seize all the gold in the Perth Mint. They'd leave you some fancy IOUs, but they'd take the gold. I reckon the next thing they might do is maybe nationalise the output of some of the gold mines. Maybe they'd say, 30% is ours, that's your that's the tax, that's a sort of a new special minerals tax we're going to put on. But as the Constitution says, because it's the federal government doing it, you'd probably get recompense in some sense. Certainly Australians would. If you weren't Australian, maybe not so much. If I owned shares in US companies, I'm not sure I'd get much recompense. Canadian companies would be a whole lot better. As Laurie said, Commonwealth countries have law that's a lot better sorted out in this respect. So Joanne and I initially, and all the other gold nerds, started to put together reserves and resources. Now, because we were mainly looking for cheap resources at the time, I'm sorry, Laurie, but we didn't actually sort out the probable and proven from the inferred. In the next version we are, of course. So we've just lumped all the resources in together. Unfortunately, that doesn't tell you much about the resources. But you'll find that the amount of resources of companies varies enormously. For instance, there are only about 8 or 10 companies on the ASX that have more than 10 million ounces. 10 million ounces is a pretty large deposit. I think Laurie drew a line under 2 million ounces of where he was interested. I'll go down to 500,000 ounces for my own personal stuff. But you can see once we get down to sort of 500,000 ounces, we're down to about 100 companies or so. Right, the next come the dollars per ounce ratios. There's various ways of slicing and dicing this. You can use market cap, or you can use EV. You can use reserve ounces, you can use resources ounce, and you can use mineable ounces. Mineable ounces are a user-defined mix of reserves and resources and what we call potential. Potential's for those yucky situations where a company probably has gold in the ground, but they can't prove it to the standard of a resource. You see, the word resource, as used on the Australian Stock Exchange, is defined by the JORC Committee, and it's fairly well policed. And so mining companies can't go around saying they've got a resource unless they really do have met certain requirements that include drilling the thing and mathematically working out how much is there and having a competent person do it and so on. But there are situations where companies don't quite meet the definition of resource because, for instance, it was done under an old South African standard which doesn't quite meet the Australian one. Or there's a lot of historical drilling that for one reason or another can't be included. Or there's a few funny cases. So we have this even lower quality measure of gold in the ground called resource, and we can mix them all up and call it mineable. And then we have these dollars per ounce. We can look at market cap per mineable, but it makes more sense to use EV per reserve ounce, per resource ounce, per mineable ounce. And this is where you get to the stage where you can say, well, how much is the gold in the ground costing you? So let's find out what's cheap. So I can sort by this column. Genesis Resources apparently has it some at $4 an ounce. Well, I don't know Genesis' story, but the second one on the list there is Platina Resources. Platina Resources is an exploration company. It has some exploration leases in Greenland. But it has a nice little exploration lease in Greenland that covers 50 million ounces of gold and gold equivalents. 10 million ounces of it is gold. The other 40 million ounces is various sorts of platinum, palladium, mainly palladium, a couple of other precious platinum group metals. But because it's in Greenland, you think, well, maybe that's hard to mine. No, not especially. It's a bit low grade, so that makes it a bit unattractive. It's probably only a marginally good operation at the moment. Probably no one would mine at the moment on current prices. It's just a bit marginal. You would probably make a profit, but you might not. And so essentially it's not worth very much at all. But this is of great interest to an investor like myself who believes that the gold price is going to go up a little bit. Because if the gold price goes up, and it'll take palladium and platinum and all the rest of them with it, then suddenly that huge deposit of 50 million ounces goes from being worth basically nothing to being worth something. Now, it's very rare to see any decent amount of gold property in Australia ever being bought or sold for less than about $10 an ounce, and here it is at $4 an ounce, so it'll go up to at least $10 an ounce. Most decent mining companies, all the mining companies, usually have gold prices starting around sort of $80 an ounce, going up to $200 or $300 an ounce. So $4 an ounce is extraordinarily cheap. I might add that Queensland is a first world country, and property rights are well secure there. So to us, as investors, that's a lottery ticket that says, all right, well, if the price of gold, say, doubles, that's going to go from being worth nothing at $4 an ounce to probably being worth a couple $100 an ounce. And the share price of Platina, which is nearly all dependent on that deposit, will leverage up accordingly. It'll go from, I don't know, 20 cents or 30 cents at the moment to probably 100 times that. Most of these companies with very low dollars per ounce, very cheap deposits, most of them are explorers who just found a small amount of gold, or they're companies that aren't mining it because it's not really worth mining in some sense, not economic. And it's not till you get to probably up around $50 or $70 an ounce that you start getting mining companies. So let's just switch across here. Let's now look at these columns here. There'll be the production ounces. This is where it starts getting interesting. So let's start looking at current production. AngloGold's the giant here. It's got a lot of South African mines. I don't know how you feel about South Africa. I feel it's a political risk. I prefer not to invest in South Africa. That's just my predilection. By the way, we also have a country score over here where we give a rough idea of the percentage. That's a customisable field. You can change your own. You can put scores for sort of South Africa or Australia, whatever you like, and it'll work that out there. Most Australian producers, let's see, the Australian producers probably start with Resolute now. It's it's a bit ambitious. Right, there's a whole bunch of Western Australian and Australian producers that produce up to around 250,000 ounces a year. So we look at their current production, their planned production. In this version of gold news, development cost is a bit weak, but we need it because often a major cost for some companies is the fact they're about to build a mine. So it's very material to a company if it's got a market cap of sort of $100 million if it's about to suddenly spend $80 million building a mine. So it's often a very material factor. And the final thing I want to talk about before our piece de resistance, the TCO, is the cash cost. The cash cost is the operational cost of getting the gold out of the ground. That's the cost that can be directly attributable to mining a particular ounce. What's the average? The difficulty is that the cost of building the mine per se is not directly attributable to particular ounces, so that is a capital cost, whereas cash costs only include operational costs. Now, if you're an investor in gold mines, it's a very important concept, all right? The cash cost is only operational cost. That's cost that can be directly tied to mining ounces, and it does not include building the mine itself. It's the cost of operating the mine. Unfortunately, there's a grey area between what's capital cost and what's an operational cost. For instance, if you build a decline, a tunnel, and it goes near some ounces, but it could be used for some other ounces later on, is that an operational cost or a cash cost or a capital cost? And that sort of grey area usually means that the mining companies like to keep their cash cost low, so they usually capitalise it. And so what we find in gold moves is, in effect, you can add about $100 an ounce to the cash cost if you want to get a realistic picture of an open pit mine. You can probably add $200 an ounce for any underground mine to get a realistic picture of their cash costs. All right, cash cost is the amount of money it takes to get out of the ground per ounce. Right, now we finally get to the piece de resistance, which is what we're really aiming for in the first version of gold notes, which is this TCO thing, total cost of ownership. If you want to own an ounce of gold by buying shares in a gold mining company, so if you buy X percentage of a company, you own X percent of its gold. You are an owner. You own X percent of everything the company has. So you can work out, using your $10, how much you spend on shares, how much gold that's going to buy you. And the amount of gold it's going to buy you depends on the development costs that have to be spent, the dollars per ounce, the cost while it's in the ground, and the cash cost. And you express all those as a per ounce basis, and you add them up, and you get the TCO. Now the TCO, if you want a quick and dirty method, is probably the main way that I use to buy gold stocks. Now I've just ordered the TCO there with the cheapest ones at the top. The very cheapest one, Latin gold. Why has that got a very low TCO? Well, because it's a gold mine in Peru. There isn't a gold mine yet. It's just a gold deposit. They're probably not going to mine it for a while because they can't find anyone who'll stump up the money for it. They've done feasibility studies on it, and they reckon that when they do mine it, it'll only cost $267 per ounce to mine. Personally, I don't believe that. We have to report that because that's what they say. But that study was probably done 2 or 3 years ago, and when it comes to actually mining, costs are always higher than you thought they were going to be. And the big clue there is that Latin gold isn't actually producing any gold. See, that's blank. So you go, all right, well, that's just a bit pie in the sky. What about actual producers? So Sylvania is a special case I'm not going to talk about. Ramelius here. All right, Ramelius, the total cost of ownership of Ramelius is a mere $473. So we're claiming that if you buy Ramelius shares, you're buying gold at $473, fully processed in your hand, effectively. And that comes mainly from a cash cost of $395 and from $68 per ounce in the ground, and a little bit of development costs. Trouble is, you've got to look into these companies a little bit more, because Ramelius is a funny company. It's got 2 mines, or 2 properties, one of which is very high grade and cheap to mine, called Wattle Dam, another one called Mount Magnet, that's an old clapped out property but still has some ounces, and particularly as the gold price goes up, it'll be worth mining. Trouble is, 9/10 of their their resource is at Mount Magnet, and only 1/10 is at Wattle Dam. So when you combine them arithmetically, the low cost of this one dominates, but it's actually that'll be relatively high cost to mine, but their mining costs at the moment are coming all from the cheap one, from Wattle Dam. So that's a bit of a funny case, but nonetheless, I think Ramelius is a very low cost company that is underpriced at the moment. And I own quite a bit of it, as does Eric Sprott. What are some other ones that jump to mind? Medusa mining. Medusa mining is a market favourite. Recently, it's gone from about, I think a year ago it was only about $1 or so, maybe $2. It's currently up around, I think it might have just hit $6. It was $5.89 on Monday. I think it hit $6 yesterday. Sorry, Sunday. The reason that's interesting, it's got a TCO of about $500 or $600. it's very cheap because its mining costs are very cheap. Its cash cost is only $184. The reason being it's in the Philippines and they use cheap Philippine labour to mine the gold. They don't use mechanised mining, they use basically percussion hammers, what do you call them? Air legs, sort of like those things people use to drill roads. So there are a bunch of Filipinos with these jackhammers hammering away in there. It's a very cost-effective way of mining. If you go up this ladder a bit, you'll find a whole bunch of the popular Western Australian stocks, all around prices around $900 or so. So if you take the ones with large productions, large current productions, and you get the ones with a just gold, oh dear, I'll just start doing them. Although some of these are no longer Western Australian stocks. You find there's a big bunch of them here. These are probably your leading stocks that brokers and stuff will tell you about. Oh, why isn't that flicking across the whole line? So you find that on a TCO basis, the market is vaguely rational. These companies that are more alike are all costing around about $900 an ounce. Now, given that the gold price is $1,400 an ounce, there's a fair bit of headroom there. One thing just a bit of background. Over the last 3 or 4 years, there's been a large divergence between the share price of gold companies right around the world and the gold price. They used to have a certain ratio. In the last 3 years, the gold price has continued up while the share price has not continued up so much. So presumably there's a lot of catch-up. Presumably the market is saying, this gold price is too high, it's in a bubble, it'll come down again. Right, there's a large it's a bubble type phenomenon out there, sort of thinking out there. You see that in that sort of TCO situation where conservatively people are willing to pay up to about $900, $950 an ounce for leading gold companies with good production and every way a good company. But they're not willing to pay $1,300 or $1,400 yet. Presumably as the gold fever catches on, that'll go a lot higher. And so what we do as golders or investors here is we look for companies that ought to be priced at $900 because they're those sort of good companies, but they're not. And Ramelius is one. Ramelius used to be in that band until it bought Mount Magnet, and then it dropped down from $900 an ounce TCO down to $400 an ounce. And we think it'll make its way back up towards $900, but it'll do so by raising the share price. We noticed Avoca did that a little while ago when it took over Dioro. It dropped out from about being with the rest of the Western Australian pack and came back in again. So to summarise, I suppose we're looking for dollars per ounce. We're looking for good bargains in terms of dollars per ounce. We're looking for EV situations that tell us that there are real bargains to be had because the market's overlooked something and something that's very cheap. Or conversely, we find dollars per ounce that are very high. And we're looking for TCOs that are either very low or very high. Most companies don't have a TCO because they don't have any mining yet. They've got to at least have a cash cost or a feasibility study that gives them a cash cost where we can give them a TCO. Some cash costs are very high. Kingrose Mining, Beaconsfield, BCD. They've got cash costs that are well north of the current gold price. That's a pretty clear indication that something's wrong. Don't buy that company. All right, for an impromptu speech, I reckon I've used up all my time. So I can't think of anything more to say. That's it. Thank you.